Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, we are gathered for the penultimate show of the year, and we are discussing two of the notable movers on the UK market in recent days, albeit one of those very much has its sights on the US. That's equipment rental outfit Ashtead. Chris Akers is with us down from Scotland to discuss further in a moment. We'll change gear after that and talk about our cover story this week, how developmental psychology can help investors think through their plans and how it might provide an alternative to behavioural finance principles. Alex Newman is with us over the line from Norwich to talk it through. We then move on to plastics maker Victrex, which reported full-year results last week to some rare acclaim. Julian Hofmann is up from Devon to talk through. And to conclude, we will touch on the bid that has finally come through in slightly more concrete terms for AIM-listed EQLS. Chris, we're going to start with you, though. We're going to talk about Ashtead. The big headlines this week were about its intention to move its primary listing to the US. We'll come to that in a moment, though, because there were, from investors' perspective, more important things to consider, at least in the short term, in the figures themselves, which disappointed somewhat. What can we say about the figures, and in particular that guidance, which came in a bit lower than previously estimated?
Yeah, so when it came to the actual results for the half year, there weren't any huge surprises, maybe a bit underwhelming compared to what analysts were expecting. But rental revenue was up 6% in the first half. You had cash profits up 4%. The margin actually improved. That was up to 47.4%. Leverage was okay, came in at 1.7 times. So no real big surprises there. But yeah, the shares were down 14% on the day, and that was because of a guidance cut. So the company cut rental growth guidance for the full year. That's now down to 3 to 5%, down from 5 to 8% before. It's also expecting lower capex spend at around 2.5 to 2.7. And alongside that, it also said it actually expects free cash flow to increase a bit from what I expected before to about 1.2 to 1.4 billion. Probably worth noting as well for context, the shares were hit as well on the following day. You had a couple of brokers who came out with downgrades in the wake of the results, and we can get into that in a bit. But so yeah, maybe a bit of an underwhelming update from Ashtead that you had the guidance cut and then brokers downgrading. So not a good few days for the company.
Yeah, a lot of this clearly is due to the US market, from which it derives almost all of its profits, which is one of the reasons it's moving its US listing over there. And a lot of that, as you'd expect, given its equipment rental as its main fare, is due to mixed non-construction spending in the US, or at least mixed spending with Ashtead. When you look at a company like this, can we read anything into the bigger surveys you get? Because you do get recordings monthly of non-construction rental, non-construction spending, that kind of thing at a national level. Is this the kind of thing investors should be looking at when considering a company like Ashtead?
Yeah, I think it's absolutely relevant. For context, obviously the key headwinds hitting Ashtead is the higher interest rate environment. You have analysts talking as well about the political uncertainty we've had over the last few months. But yeah, it is worth investors keeping up to date with surveys. We had a recent one from the Associated General Contractors of America body that found that private non-residential spending slipped 0.3% in October. So I think that's very relevant to Ashtead, given what it said in its outlook statement.
It's a reminder as well, isn't it? The US expansion, clearly a huge target market there, pretty much whatever market you're operating in. But it's not always going to be plain sailing, even in an area like this, where you think, given all the news we hear and indeed we write about US infrastructure spending, things like that. I think some of these surveys have said that, and again, we've written about it too, that many of these projects, despite the Infrastructure Act being passed a long time ago now, relatively speaking, many of these projects are taking a while to get spades in the ground. There's that political uncertainty with the change of government as well, clearly, or the change of president. So there are things to watch out for there. At the same time, I did see some comments from RBC saying Ashtead's messaging was a little bit different from peers reporting third quarter earnings only a few weeks ago, about a month and a half ago. and they think it's a bit out of sync with peers in terms of its very weak September it saw. So again, that's probably something to keep an eye on, is it fair to say, and also to keep an eye on what those rivals say in the weeks ahead.
Yeah, that's an interesting point. Ashtead's key rival in the US is a company called United Rentals. It had a third quarter update out at the end of October, and yeah, there was no similar warning in that update about the weak September and the weak market. So that's obviously a concern for Ashtead's investors, something to monitor going forwards. Although it's probably worth pointing out that RBC has also said that it expects supply-demand dynamics to improve for Ashtead over the next 12 months. So we are seeing this sort of short-term pressure, but the expectation is still for things to improve over the year.
Yeah, this is very much a blip for now, isn't it, rather than a longer term issue. And I suppose you could see the buyback they announced as a validation of that theory as well. They're clearly not too concerned in the long term. Of course, you can make all kinds of arguments about incentivization, but also about the kind of message they want to give off. But nonetheless, there is quite a big buyback announced alongside these figures.
Yeah, so it's a 1.5 billion buyback. It'll be completed over the next 18 months, is the plan. I think that is a positive sign for investors, especially in the context of the US transition. It should help with a smooth process. And also, just to make the point that we're still bullish on Ashtead as a long-term play. It's got strong margins, strong return on investment in the States. I think the market dynamics for equipment hire in the US are pretty robust. Yeah, as you said, Dan, sort of short-term blip, but yeah, I think long-term we're still pretty positive on the company.
Let's talk about the listing change. This has been bundled in with the various similar moves we've seen over the last couple of years, but this one did seem an inevitability rather than a surprise, which alongside the guidance cuts, probably one reason why there was no positive share price reaction on the day. As I say, it makes almost all of its profits in the US. It is a US-focused business, certainly since the purchase of Sunbelt a few years ago. So I think that's fair to say, isn't it, that this was always on the cards?
Yeah, I think unlike some other listing moves we've seen from London to the US, this was a case of when, not if. As you say, given the US dominates profits, I think it was 98% of operating profit in the latest year. You have all the management teams, the key management teams over in the US, et cetera, et cetera. So really not a surprise. That was a big initial news this week before we got onto the guidance cuts and broker downgrades. So that has been obscured. But yeah, not a surprise, I think, given the context of the business, where it generates its revenue and profit.
Yeah, I should say Sunbelt, I think it's actually owned for years, despite what I just said, but it's certainly expanded a lot in recent years, that US side of the business. And yeah, that clearly is the main focus. What about the valuation, though? You mentioned United Rentals, which is the big peer often compared with. We're still quite positive on Ashtead. How do we see it purely from a valuation perspective at the moment?
Yeah, one of the interesting things with the listing move is obviously often companies move from London to the US in search of that higher valuation. But at the moment, Ashtead is actually trading slightly above United Rentals. So last time I checked, you had Ashtead on 19 times forward earnings, United Rentals on 18. It's obviously very similar. But it's unclear what will happen with Ashtead's rating, whether it will get a boost from moving over the Atlantic. But yeah, at the moment, pretty much in line with its key rival.
Yeah, that listing move has to be approved by shareholders, as you'd expect, albeit probably wouldn't foresee any issues on that front. And it will retain a UK listing for the moment, so it will still be a company accessible to UK investors via regular channels. We're going to turn away from company results for a moment, though, as I said at the top, to talk about a fascinating cover story this week, if I may put it in such terms. Alex, you've written it. It's one you conceived of a while back, looking at how investors think through their thoughts, really, how they think through their approach to investing, but from a very different kind of point of view to those to which we've become accustomed and those to which economics, and particularly perhaps behavioural economics, would have it. Can you maybe set the scene for us in terms of what you're trying to do with this feature, first of all?
Yeah, I could maybe set the scene in terms of my desk, which has a few piles of books on it, one of which is unsurprisingly about finance, business and markets, and another as a parent of two quite young children is about parenting and psychology. And I suppose both themes is crowding my mind over the past year. I did wonder, I've been thinking a bit more about, I suppose the psychological approach, or the dominant psychological approach to investing, and what that both sort of tells us and the uses we can find for it as investors, but also some of the things it doesn't always help so well with. To set a bit of a broader scene, that once upon a time we had this theory of investors' decision-making process or processes, which was that everything was rational and profit maximizing, that we should see ourselves and all other financial agents we deal with in a market as self-interested and doing things because that's exactly what we want. So over the last 50 years, that story has changed considerably, and it's been challenged by the emergence of, as you say, behavioural economics, or more specifically in investing context, behavioural finance. In short, behavioural finance tries to show how our emotions, biases, and other mental distortions routinely lead us away from the path of better or more rational decision making. And this has become an enormous, powerful, and actually very useful story about our cognitive biases. And as I said, I think it's probably the dominant way we think of our own investing minds today. Just to give one example, and maybe we can discuss a little bit more about the developmental psychology after. But one example of behavioural finance that listeners might be familiar with, I know we've written and talked about it in the past, is the endowment effect, which it describes how people tend to value items that they own more highly than they would if they did not belong to them. Sentimental items aside, it doesn't really make sense to build attachments to, say, financial assets or overweight them relative to better opportunities out there. But we routinely do this. And so one useful thing that behavioural finance has been able to do is point us the ways we are irrational in this sense. But I would argue the answers that behavioural finance tries to provide, or the fixes we can provide to put us back on the more rational, quote unquote, path, are somewhat unsatisfactory sometimes.
Yeah, I think one thing you develop in the piece is, this kind of questioning attitude too, as you say, some of those solutions. And it's fair enough in many ways, and there's always a room for debate, of course, but certainly in the context of this behavioural prism, I think it's fair to say that perhaps some of these solutions have been taken a bit too much as gospel over the past X many years, X many decades, as that narrative has taken hold of investing as well. And some of maybe we can go through, there are 5 main points or main strands to the piece where we look very specifically, as you say, at how these theories or how these stories about how children learn, about how we learn to perceive the world and perceive those around us, how they could relate to investing and what we can take from them and apply to investing, the subject. So maybe we could pick out a couple of those and talk through a bit more the examples and how they might work.
Yeah. Okay. So I'll go with one that listeners might not have heard of, the technical term that behavioural finance people give to this, but they'll be familiar definitely with the concept. In the world of behavioural finance, it's said that we have fallen into what's known as an emotional gap whenever our emotional reactions come to dominate our data-led judgment. So we're trying to make a decision whether to maybe sell or buy a company, and we either get overcarried away by the fear of missing out, for example, and aren't able to hold on to what the company is doing, the profits it's generating, what the outlook is, and that we potentially we make our decision based on emotion, a combination of fear, overexcitement, or whatever it may be, rather than this very sort of cold, rational approach. Unfortunately, I think this explanation is slightly lacking. The simple fact that it's often unclear, as every investor knows, as we all know, because we talk about it when it comes to every company, that what the data says is often quite unclear. Yeah, emotion can sometimes lead us astray, but I think a much stronger answer for how we overcome these hurdles is provided by developmental psychology. And that's simply about building trust, really. So our capacity to live in a world full of ambiguity that we can't ultimately control requires us to make judgments, but also to trust in our judgments and to trust in the forces outside ourselves. How a company, for example, is navigating a marketplace, how its managers are going to facilitate that. We have to let go in many aspects of investing, rather than, I think what behavioral finance almost asks us to do is take this quite computer-like continual exhaustive reassessment of information and our own emotional reactions to it, and expect that we can somehow just keep arriving at the right answer, which I don't think is really how things play out in practice. And actually the less permanently worrisome approach is to just find ways to trust our decisions, to trust our portfolios in some ways.
It's about that acceptance, isn't it? Rather than, as you say, continually, in some ways, continually, if not tinkering, then that continually reassessing will certainly make for a more stressful life. It's almost a neurotic approach to investing, isn't it? Perhaps that behavioral finance sometimes guides us towards. So I don't want to get too zen about the whole thing, because clearly you need to keep things sharp and keep thinking about things. But there's something to be said for that, absolutely. And one book you cite as well is a book called Playing with Reality. Can we talk a bit about that as well, and how that really extends the points you've just been making?
Yeah, so there's a brilliant book. I think it was published last year by a woman called Kelly Clancy, and it's a book about games and what games tell us about our lives and how we've structured the world around games and game theory. And I highly recommend it if anyone's looking for stocking fillers right now. I think it's a really brilliant, interesting book. But I think one of the parts of the book which really stood out to me was her point she makes on game theory, which I'm not going to enter into a deep digression about what game theory is. But the point being, and it relates to what we've been talking about before, is that we can sometimes, or academics can sometimes have this tendency to think of these biases, these flaws that we continually make as humans, as the ways we don't fit a model of rational agency. And she raises the question, which I think is really important, that what if it isn't necessary that us as investors, as humans, are always flawed in our judgments, rather the model we have about humans doesn't actually fit us. And again, I don't want to risk straying into a sort of a kind of very happy clappy place, but I think in some ways, I think the lessons of developmental psychology, and I hope that kind of comes across in the piece, is to just find points of acceptance that we are imperfect, we make mistakes, and we can't judge our decisions, including the way we manage our finances, against an optimized model, because we're not optimizable. We're humans, and we are always therefore going to deviate from what a game theoretical model of our agency would dictate. I don't mean to dismiss behavioral finance, because I think it's made some wonderful, really interesting contributions to investing and the way we think of ourselves as investors, but it's not always satisfactory when you read the suggestions for how we can tweak ourselves just back onto the ordained path of rationality. Sometimes we just have to live with the fact that we are a little flawed, and maybe in the long term accepting that is better than not.
Indeed. That is the cover feature, as I say, and it is very interesting because, as you point out, there are a number of things behavioral finance has given us in terms of questioning the biases and recognizing the biases we might have. But sometimes perhaps it's not so common to consider the flaws in how we approach and acknowledge those own biases. And it's very interesting to get into that a bit more detail rather than just reflexively assume that we can resolve these issues. So do pick up a copy of the magazine, look online, as I say, if you want to look at that in more detail. For now, though, we're going to go back to the world of company reporting. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. we're going to talk about Victrex, the plastics maker, which has had a very tough time of it, Julian, over the past 2 or 3 years now. They've really been struggling, shares down by about 2/3, I think, at their trough. But that trough may now have arrived because these interim results the other day, certainly the response to them was very good. What was it that sent the shares up?
Yes,
so much?
investors are now feeding at the trough
Mm.
instead of avoiding the trough altogether. So Victrex, everyone's favourite company for all your polymer needs, it suffered in the past few years from a series of largely operational problems. There was nothing to do with the way the company was run in any sense. They struggled with input costs. They had problems with getting capacity online. Even in these results, their capacity was about 1,000 tons lower than normal. But what everyone took heart in was the fact that their volumes are now up about 15%, which had a direct impact on the headline numbers rather than the bottom line. But that was down for other reasons. But people have taken the view that combined with destocking in their medical markets, particularly Victrex is quite a big supplier of surgical gowns, it sells into those key kind of medical supply markets. Now that has finished almost destocking, people have taken the view that demand is going to organically return for Victrex, which is why the shares were up quite so much on the day. And actually, when you went through the numbers, there were quite a lot of positives. They had one-off costs, but of about 35 million. But those were just one-offs. They were just charges that they booked against some of their assets in the US. There was nothing there that looked conceivably like it would be repeated every year. That kind of affected the profit number, but not terminally. And they also had costs which they described it as not being efficiently absorbed, which I think just means that because their capacity was lower than normal, their fixed operating costs were on average higher because they weren't producing quite as much as they normally did. But despite all that, people are taking a very positive view of the company. And it is about... There are several stories behind this which are quite interesting. One, they're clearly anticipating that global trade flows are going to be very stuck to individual markets, so they're opening up capacity in China. So one of the reasons they have been spending so much money on capital expenditure was that they were commissioning these 2 new plants in China, and that process is now nearing completion. So another plus point from investors' point of view is that their capital spending, which has been pretty high over the last 4 years. I think they've spent like 120 million in capital spending in order to add capacity. That will probably fall very quickly next year as these plants come online. So it is an improving outlook, but it's more like a confluence of circumstances. It's not anything that they've done particularly to change the situation. It's rather that the situation has just changed around them, I think.
Yeah, is that, as you often is the case with investments, is that outlook which is important. These were full year figures, but they said that the next year, financial year 2025, has started ahead of the previous year and striking quite an optimistic tone, certainly on that medical division, which has had particular problems with destocking, which clearly got people more excited because those volumes, medical revenues were down 19% year on year. So clearly there's some way to return there. The other divisions, how have they been looking? They haven't been quite as bad, it's fair to say. How have they been faring? The volume side of things, at least, seems fairly strong for the full year. Transport volumes up 8%, and then you've got the aero business 15% higher. So they're already doing okay on that specific metric.
But I'm just it's expanding margins as well. So the underlying profitability of all of their divisions has gone up by about 2 percentage points because the cost of producing things has gone down. So that in a business which is so geared to a fixed cost base, as soon as you get one input which is a bit cheaper, that flows automatically to the bottom line. That won't show up in these results, but the reason people are excited is because that will come in next year. And if you have the combination of lower capex spending and lower one-off costs as well, because they've now booked all those charges, then you can see that the profitability forecast is going to be considerably more positive than it has been in recent years. So that's why the market has bought in on this. And they're in areas which are quite interesting. One of the biggest expanding ones is sustainable solutions. They sell into a lot of they supply parts, polymers for wind farms and things like that that end up in off the east coast of England. And the other point, I suppose, is that they have made themselves, with their investments, they have made themselves considerably more resilient as well. So people are more confident that those profits will come through because they won't get hammered by tariffs. All of the supply chains are now inland, as it were. So you have a China for China policy, a USA for USA policy. So there isn't this cross-border flow of material that could get tariffed. All that's going to happen is that the profits they generate in those markets will get re-exported back to the UK. So in a sense, they've been quite canny, but it's just cost them quite a lot of money.
Yeah, potentially good timing if those tariffs do come through. That China facility was open, I think, towards the end of the full year as well, giving them, as you say, that inland, in-country manufacturing capability. So that should be very helpful for them for a number of reasons. What about the valuation then? Because shares have been quite beaten down until these figures. How do we see it at the moment?
It's a strange one to value because the EPS is, on a headline basis, has been so affected by charges like the PE, something like 55, was not quite useful. But if you look at it on an underlying basis, we're looking at a consensus of about 13.6, which is just about underneath where it's traditionally been. So it's more like 16, 17. It's quite a big discount to its long-term average, and also a big discount to their competitors in Europe, which they'd be up in the mid-20s if you're talking about like-for-like comparisons. So I think that, given that all that we've said, that they're looking like quite interesting value from an investment point of view, and because they're coming from a much lower base, any increase in the share price is going to give you, in relative terms, much bigger profits. Yeah, which is exactly what happened on the results day.
Yeah, of course, it's always tough to call these pivots, but it's undoubtedly the case that it's been a tough time for them, for the sector in general, with destocking trends, and all the points you've made would seem to support better times ahead. We'll see, of course, how that plays out in 2025. We're going to wrap up today with one company that looks like it'll be off the public market very soon, albeit we have been here before somewhat. That's EQLS. Alex, you're going to step back in to talk about them, because this is a situation we've covered through a variety of lenses over the past year and a bit since this offer first came in, and they have had 12, maybe 13 extensions to the bid deadline. It looked like a bid might never arrive at one point, but it has now come in from JC Flowers as part of a consortium, albeit perhaps not at a level that would have been originally hoped for. What's your take on it, and what's the context you can provide there?
The context is that this has really been one of the strangest stories of the past year in the UK market. So, as you said, I think about 13 months ago now, actually a little over 13 months, Unprompted EQLS, which is listeners, if they're not familiar with the name, might also know them as one of the previous guys of VFX. They announced a strategic review, and reading between the lines, the board of management, I think, felt it was being the shares were being unfairly valued, and that there might be buyers out there where they could realise a substantial premium to the then the trading price, which is about 102, 103p at the time. But then it messed up. It's put itself out for tender, got a couple of sniffs, and was forced into this really unusual holding period where at first it didn't have a proper offer, and then there were indications of offers, and then an offer arrived, but it's taken a very long time for due diligence to complete. So here we are 13 months later, and we've got this bid from, as you say, this consortium led by the former Chancellor, Lord Hammond, who essentially want to merge the company with a peer called Rail SR. And the offer is at 135p plus this 5p dividend. That's up from the latest offer, I think, on the table had been something like 137p. But throughout this time, what makes it so strange is that shareholders have essentially been kept in the dark. They've not really understood why the company was initially put up for sale. And at the same time, the business has, at least according to the company, has been going from strength to strength. It's a really unusual one because there's been this kind of, there's this sort of almost radio silence at the same time as the company's been doing very well. And on paper, although a 37% premium to what it was trading at in Halloween 2023 looks like a ballpark premium that you'd expect. There's two things to consider. It was trading very cheaply then, and it has done very well since operationally. So yeah, I actually don't think this is a done deal yet. There's quite a lot of uncertainty.
Mm. Probably we'll see if it gets to a shareholder vote stage in that case. But you would imagine, given the uncertainty that's already happened, shareholders would vote through a deal at this stage, which probably also plays into the hands of a lowball bid. Is that fair to say, do you think?
I don't. I think
Yeah.
so I mean, after all this time, they've managed to cobble together 16.5% of irrevocable undertakings, and that's just from the founders and directors. So it sounds like maybe Schroders, who own about 10%, might say yes, though James Thorne at Columbia Threadneedle has called the offer absolutely ridiculous. They're the biggest shareholder. I think they own something like 11%. And he thinks it should be worth about twice the amount that private equity, this consortium, is offering. And it's clearly a strategic asset for them. And he thinks that the board is essentially just giving away business for nothing. They need 75%. It is going to be put to a shareholder vote. And normally with these things, you just get a lot more undertakings ahead of the deal being announced. And it doesn't seem like they've either been able to or had the approaches from institutions saying, yeah, this looks like a good deal. We're happy to sign on. I think there's still a lot of uncertainty now. And unless the company wants to articulate why it's a fair and reasonable price, which they say it is, but at the same time, which would contradict a lot of what they've said about the business momentum, I think there's probably quite strong reasons for shareholders to press for something higher and say no. Simon, who's written about them a lot in the magazine, may think differently, but I think he's been recommending the stock since it was at 77p 2 years ago. So I can appreciate how for some longer term investors, there is a different perspective here, maybe. But yeah, it still doesn't really add up, the situation. It's very strange.
Yeah, that's fair to say. Clearly, I hadn't done the most basic of research there. I hadn't realised that the undertakings were at
It's
that level.
moving quickly.
Yeah, the undertakings were at that level, which is pretty low for this stage of proceedings, as you say. It may well be in that case that this is going to run for a while longer, certainly into 2025 at this point. We've covered it, as I say, through various prisms in print, online, and we will continue to do so as this rumbles on. For now, though, we have unfortunately run out of time ourselves, so we're going to have to say goodbye. Before we go, I should point out to all listeners that next week's issue out next Friday is the annual bumper issue, a double issue looking at everything to do with 2025 and what investing next year might look like and what kinds of opportunities might be out there. So do look out for that. For now, though, all that remains is to say thank you very much to you, Alex, to Julian, to Chris, and to our producer, Andrew, and to our other producer, Maddie Apthorpe. We'll see you next week on another Companies and Markets show.